not all companies are going up. Some of these companies have gotten cut in half. This is a great environment for active management because we can look at these things and we can say, hey, this is just got too much risk or there's too much froth in that. So there's risk reduction techniques that we can use. But at the same time, we want to ride some of those trends. Some of those are real trends.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to episode 73, man, I can't believe it, of the Bull of Wall Street. I'm Jimmy Lee, the CEO of the Wealth Consulting Group, and we've got the three OGs of the Bull of Wall Street podcast on today together. Our Chief Market Strategist, Talley Leger, and our CIO, Jim Worden. We intentionally did not want to have a guest on for this episode, and we were just bantering about our first one that we recorded. It was on November 11th of 2024, and we've almost been at about one per week since then. We've had some amazing guests on our show, CEOs of multi-trillion-dollar companies to, the most famous tech analysts to, multi-billionaire portfolio managers and legendary investors. So it's been fun for us having a lot of guests join us for talks around the economy, the markets. And what we haven't done enough, I don't think, is to let our own experts, the two here on this podcast with me, talk about what's going on with our process at the Wealth Consulting Group, but just our views, because a lot of those views have been pretty darn accurate for the last year or two, at least, if not longer. And, we have a great process, we think, at the firm in terms of how we manage portfolios for our clients, our advisors' clients. But that being said, I think there's a lot going on, a lot of noise out here in the markets, a lot of confusion about, just where the markets are in terms of valuation. Everything is about AI today. We have some massive IPOs coming out likely soon to the rest of the year. So I want to kind of get started with that. I want to talk about where we're at in the markets. And really, these two were instrumental in coming out with our outlook for 2026 before the year started, and had an incredibly high target, potentially, the high range of the target for the S&P 500. They've both been public and in the media and writing papers for our clients around our target of 8,500 on the S&P 500, which was, as Talley would say, the highest on the street. I'm not sure, Talley, unfortunately, you're with the firm now. I'm not sure if we're included as a part of the street, but in our minds, we are. And that being said, I mean, when the market was selling off, you guys, this year, and we're going into almost a correction territory, right? Similar to last year, we almost went into bear market territory. I think a lot of people would have said, 8,500, are you guys crazy? Let me let you start, Talley, and you've held tight that whole time, including the war that was unpredictable, right? And how do you feel about it now, that target?
Well, Jim and I joke that we're not going to make any changes, but we joke we might actually have to raise our price target. And I say that kiddingly, but man, this is I think the strength of a rigorous discipline and framework and multidimensional approach to markets. And we took a lot of heat. It was a sweaty first quarter, but we stuck to our guns. And in fact, our new president, Andy Calbaugh, kind of pressed me and said, hey, can you put out a piece? We just attacked Iran. This has got to be, something unique and special. So, me, I put out that Rothschild quote, buying the sound of cannons. And it was pretty nerve wracking at first, but lo and behold, here we are. higher ground. And I think Jim's pretty happy with that outcome too.
Jim, I would ask you, and before you comment on that target and where we're at today in the markets, I think I just looked at it. We're at 75.81 on the S&P 500. So 8,500 would be about 12% away from where we're at today, I think. And I read this morning, JP Morgan in May, in a report, some of their people announced a target of 9,000 on the S&P 500, but mid-27. Oh. And so it was a big headline, article, because 9,000 is a big number. But how do you feel about 8,500 right now?
Yeah, I feel great about it, Jimmy. And, this is interesting because Talley and I both came to the same conclusion, or very, very close.
It was easy.
And it was independent. So he found his path there. I found my path there. Mine was looking at earnings growth, fundamentals, but then also technicals. And he was looking more at the top down, backdrop. And so I'm happy to see that the rest of the world is catching up and seeing that things really are firing on all, 6 cylinders, or, if you've got a bigger engine car, it's a 12 cylinder Ferrari. It's firing on all of the cylinders. And this goes back to, pressing each other on both the bottom up and the top down. So, I press Talley on the top down stuff, macro. What are we missing? What are we getting wrong? Is it really that good? And we question each other on that. He does the same thing with me on the bottom up. And we look at where do we need to be in terms of earnings growth, and what is that multiple change going to look like? We said coming into the year that earnings could be $320 per share, and that seemed kind of wild for a lot of people. And now the street is looking at $338 per share, and that's with not a lot of change in multiple expansion. So still feel really good about it. What makes me feel great actually is that there's still enough bears that are out there. There's still enough pessimism. You get the Michael Burrys of the world that are saying the whole thing's going to crash. And we hear this and there's still a lot of cash on the sidelines. Consumer sentiment still low. And so for a technical person like myself, you want to see that. What would worry me the most, Jimmy, would be everything's up. There's a lot of euphoria, and it feels, just kind of, throw caution at the wind. People are trading into stuff that they're not knowing what they're trading in. And then, multiples expand by a lot, and we have this melt up and then subsequent meltdown.
Jim, I want to ask you about that later, specifically about certain areas that have popped so fast. It seems like a bubble. It feels like a bubble. And unlike some other investing podcasts, this one is more geared towards financial advisors, and more financial advisors, I think, are a little less technical. They rely on people like you guys to manage the money. We want to manage client relationships and do financial planning and tax optimization, estate planning, so forth. That being said, most of us want to know, are you guys credible, and is the market going to go up or down, or should we get clients prepared for a lot more volatility, et cetera? So before I get into the volatility part of it, Talley, one of the things that I remember about our outlook that you guys had created was the path to 8,500 didn't mean that there were crazy things that needed to happen, right? Oh, yeah. But one of the fundamental things that was a huge part of this earnings story was tech. And when tech sold off in March, right? And with the AI, scare with software stocks and just, huge companies getting halved quickly. We needed tech to come back.
Yes.
In order for the story to work. And it's fascinating now how much tech has come back. But that being said, I was listening to, shout out to Josh Brown and the Compound guys. They have great podcasts. I like listening to that too, from just a, consumer viewpoint almost. But that on. And we know as well that actually the Max 7 stocks have been lagging the market for the last 18 months, right? While tech's been important, there are other stories beyond just those concentrated companies and the hyperscalers. So can you talk about that, Talley, the path to and why it wasn't so crazy?
Absolutely. So the outlook that I put together for us was, and this is for our advisors to use with their clients and arm them for these kind of conversations, was two parts. And I understood how crucial technology was and still is for our broader outlook. And this gets to what I call my tech enablement thesis, right? So yes, tech is a very big part of it. And I was talking to Jim, because I like to vet these things with him and just make sure that he's okay with the numbers. But I was working through the framework that I have had for a couple of decades now, working through top line revenues, the volumes, the pricing, the margin that you apply, and how that shapes or shakes out to the bottom line and the earnings trends and what that means for valuations and all the catalysts. And I was saying to myself, and this is how I convinced myself personally, it's a process, looking at the charts, looking at the data. How can you be bearish on tech when the fundamentals are just so strong and market leading as they are and have been? And the valuations, I think, are fair. When you compare tech valuations relative to those of the market, they're still fair. And the broader thing is that this is an outlook that is being driven by good old-fashioned earnings growth. Earnings are doing the heavy lifting. And given some of the macro tailwinds I know that we're going to get into on this episode, I thought the market, as a result, deserved a higher multiple, a buoyant multiple, right? In fact, that was the precise title for that special report in tech. High quality deserves a high price. Maybe I'll land the plane there. But the whole point is that with a tech enablement thesis, it's about engaging and spreading. It's a ripple effect across the areas of the market where the older economy sectors like industrials, that get the electrification concept, and utilities, right? Power generators, and the materials companies that provide the raw building blocks. That's part of the whole kind of build out and ramp up that we're calling the U.S. industrial renaissance.
Well, I think it's been awesome to watch you two work more closely together over the last 2 years in terms of your views and getting to a consensus that you're both confident in very independently, which is awesome about our investment committee, how we operate. It was like you said, Jim, with the macro, outlook and views and insights from Talley's, experience, and yours bottom up technical analysis also combining, I think it produces some really good outcomes. And one of the things that's interesting to me, Jim, is this year, everything's just not going up, right? So while tech has gone up, communication services, there's certain companies like, Meta, that hasn't really kept up with the rest of that trade. And so it seems as if investors are becoming much more discerning. And maybe I will just ask you to comment about that, because it's not because I think that just owning the S&P 500 is not wise, because investors think they're diversified more than they are. And they're going to be very highly concentrated in the top 10 companies. And it doesn't seem like that's going to stop. Now, obviously, that's been a winning trade, but we're not traders. And I think that we've seen success for our clients is that when the markets have sold off, our portfolios tend to perform much better on the downturns, the big corrections, because we are more diversified, right? So can you comment on that? And I want to ask a second question when you're done about just being more active. And you just can't buy everything, because there are some areas of the market that seem frothy, and it gives people like me FOMO, right? So can you comment on that? The more selective nature of investors today than just people just buying everything.
Yeah, it's a great question, Jimmy. And so I think I would start my way of answering is first saying, when we look at companies, we define the universe. We try to cast a very wide net. We don't want to miss those companies that are opportunities. By definition, that means that we will be, structurally underweight the largest companies. That doesn't mean we don't like them. We love those companies, but we don't love those companies at 6, 7, 8%. We love those more, as a theme in the portfolio and as an anchor to the portfolio. But when you look at these things through different lenses, whether it's multi-factor, approaches that have been around a long time, FAMA French, quality, value, momentum, low volatility. And then you throw in something like trend, and then the risk management process also looks at size and incorporates size, then you've got a great group of companies to work with, that anchored to things like revenue and also profits. Not all those companies are going to be, fitting the bill in terms of like the perfect company, but and I would say this kind of goes back to Vince Lombardi once said something about you can't obtain perfection, but if you strive for it, you can obtain excellence. And so that's what we want to do, is we want to obtain excellence. And I would say to your comment that not all companies are going up. Some of these companies have gotten cut in half. This is a great environment for active management, because we can look at these things and we can say, hey, this is just got too much risk, or there's too much froth on that. So there's risk reduction techniques that we can use if we own one of those companies, or we can get out if we just think if the trade is too crowded. But at the same time, we want to ride some of those trends. Some of those are real trends. I would say when it comes to things like high bandwidth memory, I have a piece coming out on that, here shortly. It's just a very big supply demand mismatch. And so, some of the chip makers have to, factor that in. And so that the cost is going up for some of those. And so some of these companies that are in that space have done incredibly well. And their valuations are still low. Some people might look at that and say, well, this is up, several 100%. It must be frothy. Well, it's not. At this point, it's not. Now, at some point, it might, if we get to a point where we're overbuilt and companies are, they get back to some sort of a baseline. But, we want to ride that trend while it works, that the trend is your friend.
By the way, for those that are listening or going to be watching this, that last little part that Jim was talking about, that is actually the process that he follows for a proprietary portfolio and strategy for multiple strategies actually that we run at the firm. That was very well spoken in terms of how he'd explained how that works. And it is a disciplined process, and it's proved some very good results. And I also think about the risk management side of it, because while it's had some great performance, you would think that something that could outperform the market would have been concentrated, and it's far from that, right? So I was just actually looking at some of the Barron ETFs, and we're friends of the Barron family, and we'd like to use some of their stuff if they can, if it makes sense. Now they have their ETFs, and because everybody's wanting exposure into the SpaceX IPO, and a lot of us have had opportunities to invest into that over different vehicles and SPVs and stuff. So maybe before I get into the risk side, maybe I'll start. I know, Talley, you want to go and comment there. Maybe
it's related to what he was just saying. Yeah. Actually, it's a question that kind of naturally flows out of that. So I like to give credit where it's due to your point, Jimmy. But I'm talking about Jim here, and one of the things I appreciate the most about you, Jim, and working with you, is your kind of micro to my macro and your ability to pick stocks, because I don't do that. And so I learn a lot from you on that score. And again, like just thinking broadly about WCG, coming from a $1 trillion asset management world, always in investments, but I've never been as involved in the investment process as I have been now at WCG. And so like learning about your models and how we actually manage money and being involved on the committee, it's been awesome. And I wanted to ask you specifically, Jim, about your quant stock selection model, because I mean, look, 5 factors, they're all the same factors that everybody looks at. But to your point, it's not a fully automated process. There's a special sauce and an active component. So do you really look at 5,000 different charts for all the stocks before you whittle it down to the 60, 70 names that you like?
Yes, I do. I look at every single one of them, and I'm actually trying to use some of the AI tools to make that a little bit more streamlined of a process. But it does a couple things for me because it kind of ingrains in my mind overall the aggregate of those 5,000 right now. You could probably throw out 1,000 of those that are like really tiny, not very liquid, and we probably would never invest in it. But I want to look at them anyway, just to see, from a sector standpoint, from a industry standpoint, from a style standpoint, if I look at other factors, what's going on? And so it's trying to tease out some of those themes, and we know about some of these themes, but are there other micro themes or micro factors to it that might be at work that, the markets completely haven't caught on to? So I do believe that the markets are generally efficient. I don't think they're perfectly efficient. Because if they're perfectly efficient, we wouldn't have these wild swings up and down.
I agree.
And it's human behavior, right? So like we're all professionals here. The professionals, we're all human. Retail investors, they're human too. And so there's this emotion that gets kind of pulled into it. And there's all these biases that we look at. But looking at those charts helps me look at and discern, is everything looking the same? If it all looks the same, or if too much looks the same, that scares me a little bit, because then we could have, a situation where things are too correlated. It's all moving up together. It's all going to move down together. But when I see that there's some companies that are just coming out of a downturn and the trend is reversing, and then other companies are just getting ready to break out to all-time highs. And then you have other companies that they're just a very slow, stable trend. Maybe it's a beta less than the market, but this trend is just like impenetrable, meaning it's not breaking on any piece of volatility that we get. It's just stable. A lot of those companies pay dividends. And so I look at the free cash flows and I say, well, okay, well, if we can get 10% out of that company, I don't have an explicit price target on any one of those, but if we can get 10%, price return, and we're collecting 5% dividend, that's fantastic. Some of those companies are very boring and they're not going to talk about them on CNBC, but they make sense. And so like when I look at those 5,000 stocks, I try to, flag those that look interesting, that might be good diversifiers for each other. Some of them will be high flyers. Some of them will be very boring.
Well, that's great.
Well, I was going to see if we can turn this conversation into the risk side and have you guys both comment on a bottoms up, let's say micro view, stock by stock, sector by sector, and Tally more from a macro view maybe after. Yeah. So Jim, it seems to me that we're in this environment where, first of all, there are a lot of, stocks in certain areas that have gone up so much, so quickly. And then subsequently the volatility, when we do get volatility, which we haven't had a lot of, but when we get it, it could be, in big percentages, right? On a daily basis. Yeah. It just seems like a lot more than what I've experienced in my 3-decade plus career investing money for people. How do you feel about that in terms of risk? I mean, I remember the first episode, guys, when we had Dan Ives on with Ryan Dietrich. Yeah. Dan was saying, look, we're like in the early innings of this cycle, of AI spend. And what we'll see is the second and third derivatives of the hyperscalers also starting to participate, which is what's going on now. What's happened, right? The memories, chips, the semis, and et cetera, right? All the suppliers to the hyperscalers and et cetera, to the NVIDIAs. And it's interesting also from when I was asking earlier about how investors are being much more discerning and not just saying buy on everything. As you've been saying, Jim, obviously you and other analysts are looking at like NVIDIA, for example, on what their order book looks like and the revenue and cash flow and earnings. Like they're not trading at a high multiple. Like you're close to like a Walmart or a Costco, right? Which is insane numbers. So can you talk about risk and like in those companies, for example, is there a bubble in some of those names? When we went to the halo stocks earlier this year that I think Josh Brown kind of coined that term, but let's talk about risk from your view.
Yeah. So, I mean, we look at risk a little bit different than some others, but, there's a few things. There's at the company level, it's, what am I getting for what I'm paying for? Right. So like, what are my free cash flows? And so sometimes the volatility is part of that. Right. But like, a company that's earning, a profit margin of 80% or 70%, and if the revenue growth is there and profit growth is there, then it really comes down to the question of like, how long can they sustain those margins? Right. And so you have to back into like, okay, well, where should this be if it's trading below, fair value, and then try to position size it appropriately. So I know there's some quant strategies that are going to try to have minimal tracking error to the market, meaning they don't want this to have a risk either from a sector standpoint, overweight or underweight. That's very different from the market. I honestly think that's not the best place to start, because if you want to have market like returns, you could just buy the market, right? If you're going to do that, then really your chances for active returns are really, really tiny if you're not taking on any of that. But then at the position level, we can look and say, well, we don't want to have 40% of the portfolio in 5 names or 7 names or however many names we don't want it that concentrated. We want to spread this out. And, that means that some positions would be core positions, right? Risk management, meaning that, okay, it's hitting on some of these factors that we really, really like. So there's less risk, especially if they're stable, lower volatility, high quality names. We can be comfortable having a little bit bigger position size. And then for names that, are more satellite type names that would just be different, we cap those at 1%. Some cases they're lower than that, but we're looking for asymmetrical outcomes here. We may have some losers. I mean, every portfolio is going to have some losers, to be clear. But we want to structure it such that we don't have the risk budget all going to just a handful of names. We want to have a few names that, if they work out great, that's fantastic. They can add a lot of value to the portfolio. But if they don't work out, we're not taking a huge bet there. We're looking at 50 basis points or 75 basis points in some cases. And that's really, looking at a sleeve that is dedicated to themes or to one of the factors, aside from those that would be the core that hit multiple factors.
So I'm going to jump in and interrupt you just a little bit there, because I think you're talking about the risk management process. I'm asking more about, like, for example, the momentum trade, right? Do you think there's risk like that in the market place where there are certain areas like the momentum trade that is too frothy, that could be set up for, a big downturn just because it's overcrowded? Do you see anything like that in what you're analyzing today?
Yeah, 100%. I mean, and look, we there are some names that we like that have done extremely well. And so, like, our trading team is actually trimming some of those positions today. Actually, when you have a company that's up 150% in 3 months, and the fundamentals haven't changed, the technicals still look good. Fundamentals are still good, but they haven't changed. Then you have to look at that original thesis and say, did I expect this to be up 150% in 3 months? And if that's not the case, then you have to trim. I would say some of those other names that have just gone straight up, they are more ripe for large moves down, right? If they've got large moves up, they can have these large moves down too. And all it takes, by the way, Jimmy, is a report coming out saying that, oh, this company is doing something similar. And all of a sudden people question the moat, right? That protection around the company's competitive position. And, we remember a few months ago, it was Claude, it was co-work, and it was, they can replace some of the software, and it was overblown, right? Because you had a lot of good companies that traded down a lot very quickly. So we do look at that, and I am cognizant of some of these names. And so this is exactly why we force ourselves to be very diversified. A funeral services company is not going to behave like an AI stock, right? So you have to have some names in there, or a reinsurance company. And so you force yourself to own some names that, okay, I'm only up 10%. I'm thrilled with 10%, by the way, right? And other names, you have to trim them. And some names, by the way, you are out of your control, because if there's something that happens with accounting and they have to restate their earnings, then we want to cut our losers sooner rather than later. We're not going to ride these things all the way down.
So Talley, I'm going to switch to you on more of a macro view, because you've been vocal about this on the commodity side, as we saw, certain asset classes like gold and silver skyrocket last year. You're cautioning investors to not chase that one. And then, with energy prices spiking this year with the war, where do you see potential bubbles or risk in certain areas? Maybe I mentioned them already, but what do you see from a macro view?
Well, so you already mentioned it, and I think it's because you read what I've been writing on the subject over the past couple of weeks. And I was pointing to the extreme crowding in the tech, momentum, and semiconductor trade. And I wasn't ringing any alarm bells. I'm just saying, hey, maybe it's time for a period of digestion, right? After parabolic price increases, right? This is speaking Jim's language, right? When something goes vertical, you need a breather, if you will, before the next leg higher. And so maybe that, and again, we're running diversified portfolios, right? We're not trying to make these big directional calls on concepts that all move in the same direction. We want different parts. And, Jim and I talk about this all the time, different parts of the portfolio to bloom like a garden, right? When you've got perennials, something's always kind of flowering as you move through the different seasons. And so I might actually use that little metaphor in my next piece, who knows? But I mean, look, I want to come back to like risk management. Right now, I'll say very simply, I think the biggest risk is to the upside and not participating in these markets. And we can help investors on that score. But also another form of risk is not having a complete top down and bottom up view, which we have evolved very nicely at WCG. And it's partly because of Jim and his stock picking ability, but it's also a byproduct of the nature of the cycle that we're in. So even as a macro person, now I'm forced to follow results from companies like Micron and the Mag 6 or the Mag 7. And, that's just part, or Boeing orders, because like this feeds, when you have big companies with big fundamentals like that, it feeds directly into the economic calendar, which I follow so closely. So if you don't do it that way, like a complete holistic piece or coherent piece, you're going to miss something. And so that's why I think we just keep getting better and better, Jimmy.
Yeah, one of the things that I've been involved with for our investment committee is creating this process of having our portfolios formally reviewed by some of our partners that we work with, right? Some of the biggest name brand firms out there. And sometimes they have opposing views, right? And so I think that process has been healthy for us. Just like I think, Talley, your view of, or your, now experience with coming to WCG and being more integrated with the actual investment process on implementing how to implement the actual thoughts into the accounts and then what the results are.
Yes.
So that being said, I also think this podcast has been interesting, especially for Jim, probably because he's on most of all of them as a host and interviewing all these great famous money managers out there, right? And some of them, Jim, that are more niche-y, right? That you guys know, Talley, and from the industry and are doing some interesting stuff. I think all of that is probably, for me at least, has helped in terms of just understanding where, different people's views are, right? And so in some cases are controlling a lot of money and a lot of flows. So that process, you guys, in terms of producing good investment results as financial advisors, when we're sitting in front of a client or talking to them on a Zoom or something, and we're reviewing their portfolios and looking at the performance, I remember, Jim, you and I talking when you were interviewing for the job, and one thing that I remember resonated with me was, look, Jimmy, there's lots of styles, look, people that are big, huge $1 trillion firms that are into like value stocks and small cap. And he goes, there's different things that work. They all work. It just depends on when they work. Yes. And it really resonated with me. And I'm like, man, this guy's really smart, because I believe the same thing, So, and as you know, Jim, in our conversations, I'm like, Jim, look at all these active managers that can't beat the market, can't beat passive investments. I mean, come on, like let's just get competitive returns. Don't try to beat the market. Kind of is like, no, I'm not saying that, but that's kind of silly. And he's like, no, I'm going to beat the market. So, and I want you to beat the market, right? Our clients want you to do better. And so, I'm talking about the investment process, you guys, and what produces good, consistent results. And I'd like to just have you guys talk about that. I know you've talked about that already a little bit in terms of how we're talking our own book a little bit, but for financial advisors who are listening in, a lot of them, it's unfortunate, but a lot of us, I'll point at me and people like me, believe they're like you guys or have a team, that can help really produce great, consistent results over time. And sometimes they confuse themselves, certainly in a bull market, which we've been in, and they pretend that they're the Warren Buffetts in the room, And so I think it's an actual big issue for a lot of financial advisors. And usually you can see that those advisors that think that way, they're more analytical. They maybe should be a PM. They don't have a lot of assets under management because they spend too much time doing that versus working with clients. And so if you can opine a little bit more on the investment process, what you guys think really is needed behind the scenes for financial advisors, whether they're doing it themselves or having a team like us helping them do it. Talk about the process, Jim. I'd like to have you start.
Yeah, I mean, actually, I'm going to kind of take a couple steps back here because I started many years ago, 20, almost 28 years ago. And it was as an advisor, and this was like right during the tech bubble, right before the tech bubble. And back then I remember talking to prospective clients and saying, hey, I've got this diversified portfolio that you can use. And they would say, why would I do that? I'm up 150% of my portfolio. And so framing it, I think, the way you framed it, Jimmy, is helpful because we're not there yet. It might kind of feel a little bit like that. But when the markets are doing what they're doing now, and you have multiple companies that are up 1,000%, several companies up 400, 500, 800%, call that number, whatever you want. It's easy for the average advisor to kind of differentiate between skill and luck and to, kind of draw a line between there. And for us, it goes back to process directionally, we want to be right on these things, but I never wake up one day and say like, yeah, that stock's going to go up 1,000%. Like we write it. So there is a component that, is a luck component, but the process to get in there, it's that, opportunity and preparation, equals luck, right? So if you're at that intersection and you've done the work, you've done the legwork, you've kept it disciplined in terms of like how you go through it. It's very methodical. It's not, hey, I saw something on TV and I want to buy it because they're talking about it, or maybe Talley talked about it, or I talked about it. Like that. That's not how the process works. It's very deliberate, methodical, boring, to some degree. But I get excited with, when you start going through the 5,000 stocks and narrow it down, and then you're like, okay, well, this looks really, really interesting. But then the hard work is like narrowing it down to the 60 to 70 names and then position sizing it to make sure that you're not taking too much risk. That's where, we really roll up our sleeves, and it's just, it's hard to do, frankly, for someone, if you're going to be meeting with a whole bunch of clients, for advisors to meet with a whole bunch of clients and do that just becomes challenging. To your point, what you said, Jimmy, a while ago about the appreciation for other styles. I know there's managers out there that are really great value managers. There's some that are really great growth managers, and I love them both. I actually had a mentor many years ago when I got into money management, managing the assets for a RIA that was a TAMP, and he had the top fund for both value and growth. And it was like the same manager that's doing, but it was his process that allowed that to happen. And it's because he didn't just put himself in one box. He defined the process to say, how can I look at both of these and use a framework that looks at both and includes both of them? And so I've tried to do that with, looking at quality and cash flow, return on invested capital, and price to total capital. You can identify the companies that are like good value, but they're priced right and they could grow, and other companies that are true growth companies, and are they growing enough to justify their multiple? So
Jim,
I hope that answers your question.
Yeah, it does a lot. And also, I want to pat you on the back, because one of the things I've noticed about, like, when you hear some of the great portfolio managers, whether it's equity or fixed income, and you see interviews on TV, what I've noticed, the ones that are really good, sustained over decades, they'll change your mind on certain things.
Yeah.
They're open. They're not so stuck on their, first principles beliefs when it comes to some things that they shouldn't be, that they're open to it. And I've seen that with you too. And I think that part of that's just because, your ego is not so off the charts that you think you have to be right on everything all the time, in the sense of you have to stick to your guns, unless it's something that you should be, right? So anyway, I think being open-minded and also being able to change your view based on new facts or information has helped us and helped you in terms of how you do the process. Talley, I want to switch gears a little bit. I grew up on the whole, the Brinson and, asset allocation studies, where asset allocation determined over 90% of the return and risk of the portfolio. I still believe asset allocation is extremely important. Obviously, security selection, if you didn't buy some of these tech stocks 10 years ago, maybe your performance has been lagging. With that being said, and you were talking about macro tailwinds earlier, what's your opinion on asset allocation today and how important it is? How much we need to have in, international, emerging markets, small cap, large cap, tech sector, and then switch also into how you look at that and look at the tailwinds that we have to look forward to for this year. Because I really do believe you guys. I think we got a good chance of this market melting up, which then, Jim, I would naturally think that we get some more volatility later.
Yeah.
If we get to our target. So Talley?
Yeah. Well, so this is a great opportunity, and I appreciate the question. So look, being broad and diversified has been starting to work once again. And I think this is going to get to another part of my answer. We now have more levers to pull from a product perspective. It's amazing, the financial engineering and the creativity. And I'm learning this stuff from Jim because of the way, and I want to ask him this stuff later, but the way he, evaluates managers and not just picks individual stocks, but securities as well. But now, I think we've got a lot more ways to place our bets, if you will, to use a kind of casino metaphor. But I want to kind of come back to something that we were talking about earlier. It's a full-time job to be top down and thematic and macro and make kind of directional calls and views. across markets and have a nice holistic perspective and inform the risk posture, sector, style, size. That's a lot, right? That is a full-time role. But what I've learned with Jim and working with him, it's another completely separate and full-time role to be the PM and decide, okay, I like these views, I like the themes. Now, how do we actually express that across the models and the portfolios? And Jim said it. How do you scale it? How do you size it? What part of the capital structure do we want to work in? What's the best vehicle to use to implement that trade? And should we be active or passive? That again, there's so much, it's so rich and diverse. And, again, I could just make an episode on that subject, but I think that's again where Jim and I partnering together, I think make a more coherent whole, if you will. Does that answer your question, Jimmy?
No, but so I'm going to go back to it. But it was a good dialogue. But really, it's about asset allocation. Do you still think that asset allocation matters that much in terms of portfolio performance and risk?
Oh, I do. That was my first answer. Yeah. So it's starting to work again, and I think it does matter. And I also think that that's why advisors are probably better positioned to add more value now than they have in recent years. I think the issue is you got to have, let's pick on bonds for a second. And I'm actually writing about this week. That's a part of the overall asset allocation pie where I think you have to work harder and be more selective to kind of ease that pain of underperformance as rates back up here.
And let me do a little promo for Talley. Talley writes a piece called Macro to Micro. Well, they both do actually, but that piece is posted a lot. He's got subscribers over 1,000 on LinkedIn. You should look for Talley Leger on LinkedIn and hit the subscribe button if you're an advisor or whoever want to look at his views. Talk about the macro tailwinds. Let's talk about being bullish. We talked about risk. I think that there's some huge macro tailwinds. I think at some point when rates come down, and I guess Jim, right now the futures market's got like one cut priced in December maybe today, but when rates come down eventually, and if we get the 10-year to come down and mortgage rates follow, I feel like the one thing that's going to change consumer sentiment, which is so awful, is housing. So if and when the housing market unlocks, I feel as if we might get animal spirits again. So Talley, that's the one thing that's been sitting in my mind for a long time now, even though rates haven't really come down recently. What are the macro tailwinds that you see? And by the way, another one you've been saying for a long time, which is right now what I think is really helping the market because it's trading on fundamentals, right? Earnings and margins. You've been saying because the economy has been a little bit soft. We also love Jim Paulson, and he's been saying that, there's a little bit of weakness underneath the economy that people aren't really seeing. And I think he's been right, although the earnings has been good. But it seems as if the margin expansion, because labor costs have been controlled, which is what you've been saying for a long time, is helping that earnings story. So setting you up for macro tailwinds. Talk to us.
Yeah. Well, so again, I think that a big part of it is microeconomics, right? But I'll take a step back because you asked about macroeconomics. So I wrote a piece recently talking about our four-banger economic engine. That's the U.S. economy and the four cylinders. And they're all firing. And, I was kind of shooting back at this kind of angry economist argument that we have a breadth problem in the U.S. economy. I don't see it, right? Because all the pistons of the engine are firing. The way I would characterize it or qualify it is that they're one of the pistons. That's if you think about the Y equals C plus I plus G plus X minus M in the GDP equation, it's coming from the business sector, right? That's the bright spot on the U.S. economy, and that's in turn being driven by more micro forces like semiconductors we were just talking about earlier, and the whole AI ramp up and build out, which is becoming I think a mania more and more, and that's the runway. But the whole point here is that it is the microeconomic aspects of this cycle that are really the strengths. It's the top line revenues, the margins, and the earnings, right? That's the business sector, right? So we call that microeconomics. But back to the macro side, look, yes, in the very near term, we have seen a mechanical bump up in energy, which in turn has started to fuel headline inflation. And this is all because of the war. And the saving grace here, Jimmy, is that because it's so mechanical, I think it's largely expected. People understand the gap between energy prices on headline inflation and core inflation. This week's PCE reading was kind of a nice reminder of that. Even though we did see an acceleration in the headline reading, the core was relatively muted, right? So again, I think and it looks like we're kind of working towards some kind of a resolution. Once the war winds down and the Strait of Hormuz normalizes, I always say, and I'm a big believer in quotes from the past, the best cure for high prices is high prices themselves. Mm-hmm. There's a lot of oil on the water and it's going to find a home, and producers are like, they're salivating at these high prices, which surprisingly aren't too high, talking about oil. But I technically, I know Jim and I talk about this all the time. I like looking at the patterns. I think the price of oil in Texas wants to collapse, and we could actually be facing a supply glut. And that's going to bring inflation back down. Rates could calm back down. I don't think they're crazy, but you can read my weekly thoughts on that here today. And again, we're going to be back to the races.
By the way, I'm going to correct myself on Talley's. It's called the Market Flash, I believe, is the weekly one on LinkedIn. That's the one to look for, guys and gals, everybody. Jim, can you talk a little bit about this broadening trade or not broadening trade? Are we going to finally get more broadening, you think? And then I wanted to get your view on, what you think about interest rates. Will we get one cut? Will we get a hike? Will we get more cuts? And then I wanted to have you guys talk to each other, because I know that you had some interesting things you wanted to ask Talley about his background. So let's start with the broadening theme, and then interest rates, Jim.
Yeah. So on the broadening, I think it is happening. I think this is, you mentioned our very first episode with Dan Ives, and he mentioned the second, third, fourth derivatives of the AI trade. And in the beginning, it was just, a very few companies that were benefiting from this, mainly NVIDIA, Broadcom. But then now you've got AI working its way literally into every sector and industry of the economy. And so to the degree that these companies are unlocking productivity and, to Talley's point, boosting margins and growing. Yeah, I think that this market has legs to stand on in terms of the broadening. It's interesting that the smaller companies, so the Russell 2000, they've actually been really participating well. Some of the companies, in the mid-cap space haven't. And it just depends because some companies are embracing this and, riding the wave. Other companies are getting crashed by the wave because they're being disrupted. And so it's messy. To be clear, this is not a rising tide lifting all 100% of the boats, but that's how we want it to be, right? I mean, active managers want to see some dispersion of returns. We don't want to see everything moving up together because they can all move down together. So I do think that broadening is real. I think it's happening. And look, we could have a situation, we've had this before where, our country needed a stimulus package and the government would write checks, right? So we would have $1 trillion going out to everyone. And that helps. That helps a little bit with consumer spending. Now you've got the private markets that they're spending, trillions of dollars and capital expenditures. And that's private sectors deciding where is the most value going. And this is where I'm going to spend the money. And so that's another reason why I think that the market's broadened. On the interest rates, I think that, by the way, all of this inflation, all of this, technology revolution with AI and everything that we're seeing with productivity, this is going to be disinflationary. Everything that we're doing to electrify our country and move away from oil, that's going to put more pressure down on oil prices. So those things are disinflationary. I do believe that when inflation is coming down more, part of the reason why it's sticky is because of the housing market. You mentioned that, Jimmy. But as that comes down, inflation is going to come down. I also think that the Federal Reserve still needs to pay attention to the labor market. And we do have this kind of K-shaped, everyone's talking about the K-shape. It's basically that the people that are doing well in the labor market and the people that are not, right? And so and there is the potential for disruption there. And so I think the Federal Reserve, to be proactive, I think that I think they should err on cutting rates rather than the raising rates.
Talley, I would be remiss if I didn't ask you this, since we've got our macro expert on this, and I think a lot of advisors want to know about this, or your view, or when interest rates were climbing and yields were, they still are, nearing some very high levels recently. I think there was a few people out there, like Warren Pies, I like that guy too. He was talking about, wrote a report on the economy is actually heating up, and the economy getting better, and that'd be a good reason, right, for why rates are going higher. And or, Talley, is it because investors are concerned about our debt levels, right, which we know is another huge theme out there? Maybe not so much about why rates are going up, but what's your overall view on interest rates and how it factors into the overall macro environment that we're in the dollar, et cetera? Go ahead.
Yeah. Well, so I mean, look, I think financial markets are by and large doing the Fed's job for it, as they often do. I'm not sure I buy into the whole don't fight the Fed. It's the markets that tell the Fed what to do, not vice versa. And the good news is those financial conditions are broadly easing, and that is engendering and supporting an economic reacceleration. That is one big part of my overall macro view. Another part of it, Jimmy, is to use an historical analog, the central scenario that's driving our 2026 one is, and it's so similar, it's kind of a little bit eerie, a little bit haunting. But what we're seeing now is this kind of hawkish tendency at the Fed, which is kind of echoing the one-off kind of head fake rate hike that they enacted back in the mid to late 1990s, which ended up being a mistake, and they went right back to cutting rates again. And that's what we've been saying. Like, this is kind of a repeat of history, and so you got to know your history, right? So the Fed could very well be on the leading edge of easing into an economic acceleration and kind of fanning the flames of economic growth here. And so, but I'll come back to another thing that you asked me, Jimmy, because there's a lot to unpack. So, and I'll throw some theory at you. So I actually did a decomposition of the 10-year in this week's flash. And so this helps us kind of literally answer why rates are backing up. And there's two components. I'll make it really simple for our advisory and client audience. One component is of the 10-year, an embedded expectation. We'll talk about the average expected path of the federal funds rate over the next decade, right? That is one big component that's explained or embedded in the 10-year Treasury bond yield. The other part is a kind of nebulous, it's called the term premium, to use a wonky concept, but it's this nebulous catch-all for everything else that's embedded in the 10-year Treasury bond yield. And there's a lot. It's real growth, it's inflation, it's the debt question that you asked, it's expected volatility, all this different stuff. And you can break that all down, and you're going to hear a different narrative, whether you're listening to an inflationista economist or a naysayer kind of boom, doom and gloom person that's ringing the bell about the debt levels. But at the end of the day, I'll make it very simple. All investors are asking right here is for a little bit extra yield to compensate them for taking interest rate risk. It's as simple as that. And so that is literally 0.8% of the 10-year Treasury yield, which is what, around 4.5%, right? So that's literally the answer. That's all it is. It's not crazy. And when you look broader, we like to say, when in doubt, zoom out. The current level, 4.5% of the 10-year, is actually quite reasonable relative to the pace of nominal economic activity, which is 6% year over year. So the Fed is literally underwriting growth. And so I don't know, Warren, but I would generally agree with that view. So as long as the pace of economic activity is running faster than the 10-year Treasury bond yield, look, we're off to the races, and it very much supports our bullish conviction. And I would say from an inflation and valuation perspective, I hate to break it to the doomsayers, but the 10-year Treasury yield is fairly valued. It's not crazy. And, if we're right about all those macro things that we were talking about, I might actually add a little bit bonds to the portfolio here. I don't know. What do you think, Jim?
Yeah, I agree with you there. And I think there is plenty of there are plenty of folks out there that are like really, really worked up over inflation. And I think like with technology and with this kind of, we're not going in a straight line on AI and AI build out. This is a little bit messy. It's a back and fill. And so you've got things that you don't intend to have happen, like memory prices moving higher. I mean, there's some temporary inflation that's in the system, but it gets worked out, right? I mean, no different than the oil price spike that we see. That's going to get worked out. It's going to come back down. But long term, yeah, I agree with what you're saying there, Talley.
Can I ask you about that? Because I'm kind of chomping at the bit on this one. We were talking about we're going to put our technical and our economist caps on for this one. I was reminding you about hedonic price adjustments for the audience. This is this kind of secular concept or structural concept where in technology, we get more and more and more for less and less and less. And we were kind of remembering back in the day how much it cost to buy some of the earlier or first generation flat screens. And now, like, you can get a G5 for half the price, right? It's awesome. So help us in this conversation kind of juxtapose the near term or we'll say cyclical dynamic of rising chip prices vis-a-vis that longer term kind of concept of, look, the producers are going to come online. And I wrote about this in recent weeks, right? When you have robust sales, that begets robust capital expenditures, business spending. And so when prices are this high, they're going to build out capacity, and we're going to have way too many chips at some point. We're not going to know what to do with. So does that mean that these near-term kind of price increases for the chips ultimately are going to sort themselves out?
Yeah, and so the piece that's coming out hopefully today is called cyclically secular ? Right? Because these chips usually follow a cycle, and it's okay, we're boom and bust, and that's why there's value, that's why there's volatility. Valuations usually aren't that rich for some of these names, like Micron's a good example of that. They go through this boom and bust, but this is an elongated, feels more like a super cycle because there's just so much demand, and they can't build enough chips. The high bandwidth memory chips for NVIDIA, Broadcom, all, Taiwan Semi, they can't build enough of it. That's squeezing the rest of the chips that people use in the regular computers. So if you're a video gamer, you're like, wow, everything's gotten expensive. But we will get to the point where that capacity is there. And some people are like, well, it's going to happen next month, or it was going to happen 6 months. The fact of the matter is, a lot of these, hyperscalers have got longer term contracts, sometimes 3 to 5 years,
right?
Fixed pricing,
which
they normally don't do that. And so again, this kind of goes back to Dan Ives recently said he still thinks we're in the third inning.
Wow.
I think we might be a little bit beyond that, but like we're nowhere near the 8th or 9th inning, in my opinion, on this build out. Because we're gonna keep building and building, and the software is gonna get better. And I know Claude 4.8 just came out yesterday, and so these things are getting smarter. It's getting more efficient. By the way, the chips, like you said, to your hedonic price adjustments, is the chips are getting better. They're getting faster. They're requiring less energy. And so like every iteration,
that's right,
they improve it. And so right now we're paying for it. There's premiums, but it's going to normalize. And, I think that this is not going to be something that the bottom comes out.
Jim, before you leave, I'm sorry, go ahead, Talley.
Well, I was just going to say, just to kind of make that sink in, one of the key charts I showed last week was global semiconductor sales growth is 90% year over year, a record. It's been higher in the history of that series. And it's like we'll pick on Micron. I think their customers are only getting half their orders. To your point, Jim.
Yeah.
And these are like cutting edge companies. They're not calibrating their business spending with their sales, and the CapEx build out isn't going to, like new capacity I'm talking, it's not going to come online until next year.
Yeah.
It could be a while, right?
Well, before we leave this conversation and maybe end with a little bit of a kind of Talley's unique background into Wall Street, Jim, because I think that you wrote that question on our pre-call. Before we get there, though, I want to talk, one last thing is energy. Everybody talks about energy being the potential problem with the AI build out and subsequent, investor CapEx spending and results that we're seeing so far. And what I hear is natural gas is what's driving the energy. And so I'm assuming that since we're so abundant in natural gas here in the United States, that gives us a huge advantage for our companies that are, has factories here, et cetera, manufacturing. And I hear about nuclear, and I've personally gone off of our model and purchased a few SMRs myself, and it's been very volatile. I know you've had one in one of our models and thank goodness you timed that properly because it's had a lot of volatility. But can you guys talk about energy, and maybe more you specifically, Jim, about what's the risk there? What do you guys see in that?
Yeah, I'll go first here. I think the risk is, just putting all of our eggs in one basket in terms of like, it's all going to be natural gas or it's all going to be nuclear. Like, and this is where, again, we're active managers. We believe heavily in diversification. That is something we just don't know. Honestly, when it comes to how are we going to support all these data centers? What's the build out going to look out? Building data centers out in space and SpaceX involvement with that. I mean, no one can forecast precisely with precision, where this is going to end. But I do believe that oil prices are going to come down just because we're going to move. There will be a greater shift toward electrification. I agree with you, Jimmy. The natural gas is really where it's at. That's the cheapest. It's most ample supply for our country, and we're exporting it to the rest of the world. So I think that's probably like the core of it, but it's going to be everything, right? There's going to be some solar, there's going to be some thermal, there'll be some nuclear. Now we're reading about nuclear fusion, which would be amazing. That would be disruptive, and it would be good for everyone, right? So I think we're going to continue to see volatility. Now, if we can get the Strait of Hormuz secured and stabilized, and if, as Talley mentioned, you get other production coming online, that alone is going to bring prices down for oil. So that's kind of my take on the energy.
Talley, are we going to have enough energy to power all these data centers? And one thing that I always remember from Nick Murray is, besides love, human ingenuity is the most powerful force on earth. And yes. I feel as if that's what's going on right now. And that's what's driving this economy, right? We'll figure it out. Humans will figure this out.
Yeah.
We're the ones that created AI, right? So what do you think, Talley? We're going to have enough energy, or is that going to be a big roadblock, you think? Everything's going to come crashing down because we're out of energy.
Well, so, I mean, that's another famous quote from history, right? Necessity is the mother of invention. And so I like the space theme and the whole concept of the space economy, not just because I'm a science fiction fan, but it solves a lot of problems. If we can get these data centers up into space, number one, you got a natural cooling system, which is devoid of space, right? And so maybe that would mean bad things for companies like Fix, comfort systems, in other words. But it would also get us closer to an abundant source of energy, and that would be the sun. So putting solar panels on those orbital data centers. And guess what company is the only one that can do that right now? And why it's going gangbusters, like the mania, it's SpaceX. So that solves a couple of big thinkers in our economy and markets. But coming back to the energy story, remember, it's the energy sector that is fueling the utilities sector and the data center concept that we just kind of explored a little bit. And so I think you've got to spread your bets and think about the older economy sources of energy like natural gas and nuclear, which some consider clean. I don't know. I don't know if it's necessarily so clean. What do you do with the waste, right? But I would say when it comes to oil, the last time I kind of tried to quantify this, and when I said there's a lot of oil on the water, what I was talking about is I think that there's about a shortfall of 1 billion plus barrels of oil. That's what the Iran war took away. But guess what's on the water? About 1.6 billion. So there's more than enough. It's literally a supply glut. There's more than enough oil near and around the Strait of Hormuz to in the near term cover that shortfall in supply. The question that we should be asking is, well, I understand that's why oil's not $200 a barrel, but why isn't it 60 or 70? That's the pre-war level. Mm-hmm. Because and this is a nuance for the energy experts, it's generally the wrong kind of oil that's on mm-hmm. the water, right? It's a heavier sour grade and they want a lighter sweeter. But the good news is, and Trump's a businessman, guess what? That's what we produce in the US. And so there's going to be winners and there's going to be losers. And I think that as a result, if we ramp up production the way he wants, the U.S. is going to come out of this looking pretty darn good.
So I know we ran a little late. Jim, I know you got to get going for something. So I'll just ask Talley Jim had wrote the question, but Talley's got a unique background getting into the investment industry. It's a music background, which Jim, you ask him. Sorry.
Well, no, it's all good. I just know you have a music background and, I just wanted to see if there's a connection there with cycles and rhythm and notes and booms and busts, right? Because like there's a pattern to all of it. Tell me about that, Talley. What do you think?
100%. I think this is why, Jim, we can have really good deep dive conversations because we're both so visual and we're chart guys. So yeah, this was the subject of my master's thesis, and I did a directed study with the chairman of my program, and it's one of the reasons why I'm so thankful, because I was changing careers from music to finance. I absolutely had to go back to school, get the graduate degree, Master of Science in Financial Economics, because I needed that full immersion, right? The classroom time, the books, and I actually, the investments text, the financial Bible. Zvi Bodhi was on faculty at BU when I was there, and I read that book from cover to cover, right? And so that's why Tom Keene always kind of kids me and jokes with me about that. So I didn't go the CFA route like you, which is a great professional certificate for working adults, but I needed that full-time classroom learning and the lectures and the group projects and the tests and the quizzes and exams and all that stuff. So what I did was, and I realized this is a positive transfer of training from music to mathematics, and music is inherently mathematical. And I mean, starting with the simple language, right? It's basically the Cartesian coordinate system, right? There's verticals and horizontals. And you learn this in music theory. When you're analyzing a musical score, there's voice leading and there's point and counterpoint and all these musical concepts that directly transfer to the markets. And that's why I got good very quickly at finding it's pattern recognition. That's all it is, right? And that's technical analysis. And so that's why, and I'm going to come back to a question for you on this, but when I was at ISI as a junior strategist, this is very early career, it kind of struck me. And I was working with the number one ranked economists as a market strategist. And I kind of laughed, and I want to get your take on this, Jim, but it struck me that all those economists are really doing is applying technical techniques and analysis to macroeconomic data. And this is why in my work, I'm still a big fan of showing big fat charts. I'm still getting better at writing less because I tend to be a little bit long-winded as I'm demonstrating, but very, like bullets, very little words and big fat charts and arrows and trend channels and all that stuff. But what do you think? Are they just kind of glorified technicians?
In some ways, yeah. Well, and I do remember having a conversation with a friend of mine who worked at Fidelity, who has a very nice chart room in their office. They've upgraded it a few times. And he was telling me that all these portfolio managers, most of the portfolio managers at Fidelity, they may not say that they're technicians, but behind closed doors, they're looking at the charts, right. just like you and I are. So it's good. And you know what? Listen, I think with AI and machine learning, now we have computers that can help us connect some of those dots where there are dots to be connected, right? It's pattern recognition, but it's like, we can do so much more. And look, there's a lot of money that's being spent. I was meeting with Goldman Sachs and AQR a couple of weeks ago, and they spent a lot of money on these AI machine learning system, and it's adding value. So I think it's exciting. I'm actually very optimistic for the future because of that. But I just wanted to point that out because of your music background. I think it's pretty cool.
Thank you. Well, there's crazy research on this stuff. Like just having children, they have control groups, but having children listen to the Mozart double piano concerto for a few hours a day meaningfully added to their test scores and boosted their IQ. It's crazy stuff. And there's not enough research on this, but like even the rhythm in music is inherently mathematical. And I could point to other things like this gets really wonky. Like when you're learning keyboard training, what it does is develop a unique skill. It's called spatial temporal awareness, so that when you're playing notes and intervals on the keyboard, you're actually mentally connecting the dots with the sound and how it feels physically. And so, and I know this is like when in my testing, it gives you crazy abilities to wrap your mind around multi-dimensional concepts like that. And that's why I've gotten good at introducing lags and identifying, if something happens now, what that means 6 to 12 months hence. And that's special sauce in forecasting.
That's awesome. I don't know if this is true or not, but about 15, 20 years ago, somebody I follow said that the Russian athletic commission or whatever that's called for the Olympics used to have their athletes, or they might still, I don't know, listen to Baroque rhythm when they're training and or when they need to think and stuff like that. So anyway, that's fascinating. And I would like to end this talk today, which was awesome. I thought was one of our best ones on a lot of different things I think that are relevant for advisors today. And other advisors can do this. Jim, I'll never forget, Jim, last year at some point early, you showed on one of our investment committee meetings, these, fake people with names that you named them with all the LLMs that you were using to help do some of the research for yourself and on the investment committee. So I think AI is absolutely, in the business in a lot of ways already, and helping people like us be more productive, right? So maybe we'll have a whole another session around that. Next time, you guys should kick me off, get Paisley on, and you guys should do this more often. So thank you very much today, and appreciate it.
Jimmy, thank you. Before we wind it down, I want to give you a big thanks for building such a great business and giving us a platform for Jim and I and the rest of the ISC to be in our genius and do what we do best.
Thank you.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.